Good evening. In this video I'll show you three companies that are among my favorites. I think I've owned them for around close to 10 years, all of them. And it's pretty simple. I'll show that they have been big contributors to my return the last decade. I'm close to having around 18% annually since 2016. That's when I pivoted, you could say, focusing more on companies that just get stronger and stronger every year. And I can show you here. I picked up the letters from the legendary investor who happened to share all of his good ideas, at least the attitude towards investing and what counts and what doesn't. And then I just sat down and I wanted to read all of them, so I highly recommend you to go and read. And if you have an investor who has had a compounded annual gain of the book value and the market value of the shares by close to 20% every year for 60 years, and he shares what he thinks, I think that's a good idea to go and look for free. So you find a link below here eventually with the letters to Berkshire Hathaway. That when I read all of those, I was sitting in a cafe, had been investing already for quite a while, but it wasn't that easy to get stable growing dividends. But I wish I had read those letters before. And from that time, I found these companies, American Express, and of course Berkshire Hathaway. I invested in Berkshire Hathaway in 2016, I believe. I also bought American Express actually before in 2015. And I'll share with you that this is a stock that actually gets cheap all the time. And also I invested in Google or Alphabet. That was in 2018 or so. Almost 10 years owner of this one also. And in common with these, I guess it's safe to say that they have always been too cheap. And right now, yes, they are they are on the expensive side in terms of price earnings ratio. And maybe it's even more expensive than what you see here. But I'll show you. I can show you more in the channel about these stocks. But a big idea was, as Warren Buffett would say, to try and own these companies that only get stronger and stronger. I was investing in like buying entire businesses, small ones that would maybe it would earn, let's say, like a price earnings ratio of 3. And I thought that if I can just have a stable income from that and buy one more, then it would make a living just buying businesses. But then it's not easy when suddenly they would go into minus, and then I wouldn't be bothered by the share price, but I wouldn't be making any money with it. So then it was hard. And how can I make a living investing in businesses if they stop earning and go into minus? So then I was reading the letters here, and Warren Buffett had been investing early in American Express, for example, and he shares that when he doesn't look at quarter to quarter, but he looks at the earnings that the company is generating just over 5 years at a time, for example, or long term. And I was reading the Berkshire Hathaway letters, and that they just increased their ownership in American Express. Because American Express was kind of buying back their own shares over time. So if I show you here, just see the long view here from fiscal.ai, you can see here, if you would have seen this kind of development, earnings per share, wouldn't that be pretty good? It's since 2005, it's pretty good to have a growth rate of 8%. Or so. You can see it down below here. That's measured over that, but it's not also not the best maybe. But of course, Berkshire Hathaway, he had another lesson that I'll share more in detail, that he also kind of used float or getting a kind of a leverage effect on these returns. It made it even better. But I was sitting and thinking that if I can just grow my income from my investing by let's say 8% a year or 10% a year, that would be super good, instead of going 10 years and then suddenly it wouldn't earn any more money. So having a business like this, or having a business like Google, that, for example, I invested in Google almost 10 years ago, and in comparison to this real business that I owned 100%, it would have been, in hindsight, much better to just own Google, of course. It earned $2, $1 and $2 10 years ago, and now it earns $10 per share. That's fantastic to have a business where it earns even 3 times as much in 10 years. But here it's amazing if you can just sit and be long-term investor here, and it's actually not that expensive if you look back in time and see, I paid a price earnings ratio of 20 or 25 even, and the earnings yield was less than 5%. But if you just own it for a long time, both American Express or Google, it's actually pretty good to be a long-term owner, even though it looks a little bit expensive. So here you see the earnings yield, for example, of Google. And if you looked back here in 2018, for example, and see a 3%, that was pretty good. But now it's only 2% or 3% earnings yield. That doesn't look so good, does it? But we see the history now that it has actually been really, really good, because it's growing without any debt. But now maybe, of course, it's back to being expensive now. But who knows in 10 years how it will look? But I think it will probably be stronger. So that was those two, and of course Berkshire Hathaway. And you can see here that it's pretty simple to look at those stocks. Another one I bought in 2019. It was the most expensive stock I had bought. It still is. I just hope it will get cheaper. It never gets cheap. So I was then just looking at the earnings per share, for example, back in 2000. It was the 2018 numbers, and it was like, when you looked at those numbers, just I was sitting here in the office, and then looking at this in the lunch break here, and it was like, the earnings just grow and grow and grow. And in 2018, for example, it was earning $7, and then 10 years before that, that had almost tripled its earnings, and it was a price earnings ratio of 33, and that was so expensive. But I made it into one of the bigger investments then, and then you see, of course, after it just keeps growing. So I should have picked up, or actually I should have actually learned and taken it really serious, that it can be worth to pay a premium or a higher price if you have a really, really strong franchise and company, and just don't look at the quarters or don't look at the stock price, but just look at the playing field here. That is this business now, is the growth going to stop, or is it even stronger now? So that's a philosophical question there. But in my opinion, I don't want to sell a single share of Costco, even though it's super tempting, because the price earnings ratio has been 40 and 50. But I have actually bought a little bit more when it was. It went down to $850, and I was saying on my Norwegian channel that finally now it's starting to get more towards the cheapest it's more profitable than it was in 2019. So I am gladly paying a little bit more comparing to the earnings we have now. But then it went back again and got more expensive. So I hope to maybe I'm being stupid not buying more at 850, but if it can make a little bit of comfort, even the legend investors, they sold Berkshire Hathaway sold it in 2020 or so at $380, I think. So it's not easy to see, but this is an example. It's quite fantastic to see earnings just growing and growing and growing, and not even being negative in the financial crisis of 08 and 09. But yeah, that's kind of what I want to look for. And you can see that the balance sheets of these companies, Google, American Express, and Berkshire Hathaway, and Costco here, they are really strong. For example, you can have a look at the debt and the equity. And you see here that they have actually, for example, here in Costco's case, you have negative net debt, or meaning they have more cash. Even though they would pay back the debt they have, they would have more cash on their account. So pretty strong, and I'm looking for these kind of companies. Join me, and I have a watch list here that we monitor. You can follow me on the channel, and we'll have a look at some great assets that I believe are getting stronger and stronger, and we are going to try and wait patiently and add more when they are getting cheap, and then just try not to look at the share price anymore, and then just see, maybe 10 years from now the earnings will be 3 times as much, and then maybe for you it makes sense to pay a little bit more than the average company, for sure, and then maybe even paying more than you usually do. Okay, thank you for watching the video. Hope to see you in the next one, and feel free to join and suggest companies if you see someone that fit these criteria.